Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group, and welcome to another episode of InFocus. Today, we're going to look at the second quarter investment overview, and joining me is Brian Durno, our Chief Investment Officer. Welcome, Brian.
Thanks, Mike. Great to be here.
Great to have you on the show. Folks, this is a webcast. If you're watching this, that's intuitively obvious. So we have some graphics we're going to step through. If you're listening in your car or through your favorite podcast platform, I'd encourage you, if you have a chance, look at the graphics and follow along. Otherwise, feel free to just listen to the audio. We'll do our best to describe what we're stepping through. One thing I wanted to address, we got some feedback in terms of, the timeliness, in terms of, a quarter ends and it takes a while before we start talking about that quarter. And, a lot of, there's other organizations out there who focus on the markets themselves. And while that is important, we always like to stress we're bottom up folks who focus on fundamentals, right, Brian? And so one thing we want to make sure is before we start talking about the quarter, we want to know how our businesses did, right?
100% true. Yeah. And the macro, let's say, economic environment obviously plays a role in us understanding the consequences on the bottom up companies that we own. So that is very important. But yeah, you're quite right that you have to wait for earnings season to kind of see what the results look like under the hood. Exactly.
So with that, why don't we just dive into some of the graphics and we'll step through what you and the team are seeing. Start with what we're seeing with respect to interest rates and specifically the U.S. and Canada. What are we staring at here, Brian?
Yeah, well, this is sort of interesting. A lot of attention is paid to both central banks here in Canada and the States and elsewhere. And it's interesting to take a longer term perspective and have a look at how closely tied the bank rate have been between Canada and the U.S. over the last, say, 30 years. We're showing a graph from 2006 basically till today. And you can see how tight the band was between the two central bank rates. And actually, that sort of makes sense when you think about both of the policy goals of the central banks is to generate, let's say, 2% target inflation. So it kind of makes sense that they'd be tightly correlated. But what we wanted to show in this graphic was just how disconnected the two bank rates have become between Canada and the U.S. in the last little while. And we'll talk a little bit more about why that is. But you can just see that last period there of how much difference and how much of a gap there is between the U.S. rate at around 4.5 to 2.75 in Canada.
Well, and we'll talk more about Mr. Trump, President Trump, and lots of noise he's making about the Fed, who does set that short-term interest rate. So we'll talk a little bit more about that. Obviously, one of the drivers you already touched upon it is inflation. So this is a good graphic again comparing the U.S. and Canada.
Yeah, and this is great for folks that haven't really been watching super closely on how things have changed, outside of the COVID experience. So prior to COVID, of course, the inflation rates between the two countries were, relatively benign and let's say under control for a long period of time. We got kind of used to that. And then you see this massive hump that pretty much occurred during the COVID experience. And we wanted to highlight in this chart was just how divergent they were back in November of 2024. The two inflation experiences between Canada and the U.S. had really become disconnected there. And we would even argue today that the inflation rate in the U.S. is just a little bit stickier than it has been in Canada. There's a little bit of noise with the GST and the carbon tax policy changes in Canada that are influencing some of the numbers. But we thought that would be a useful thing for people to see, especially that last period, like in that yellow part of the line, you can see the, let's say, the change in inflation rates here in Canada in the last little bit.
For sure. So let's talk about unemployment. Definitely, again, differences here we're seeing between Canada and the U.S. U.S. still quite strong.
Yeah, it's a continuing theme. You used to being these graphs very highly correlated, and in the more recent experience, starting to disconnect a little bit between Canada and the U.S. And unemployment rate, most economists would likely ignore that massive spike you're seeing there during COVID in the unemployment rate. And if you do that, you can see that the unemployment rate, it actually just came out this morning in Canada too, at 6.9%. You're going on almost a 10-year high there in unemployment rate. And that compares to the States where you're a little healthier level at 4.2.
Right. 10-year high excluding the COVID spike?
Exactly. Yeah, I figured, obviously the COVID experience is going to skew the data, and that was, let's say, a
For
very
sure.
unusual
Yeah.
spike. Yeah.
Yeah. Yeah. Fair enough. Let's, bring it back to the shape of the yield curves. This is always a good graphic for folks who track this stuff, and those who don't. It's still a good graphic because it gives you a feel for what the short-term interest rates down here around 30 days. That's governed by the various central banks, and then anything further out is really governed by the market. And so you can have the bond markets and the like. So talk about what we're seeing here in terms of the differences of that shape of the yield curve between Canada and the U.S.
Yeah, most investors are used to the idea that if they lend their money out to somebody, that the longer you lend the money out, the more risk there is. Therefore, you require a higher rate of return to compensate you for that, let's say, time frame risk. And in the U.S., you actually have a mild inversion there in the short end of the curve, and you're quite right that that's being held up by, let's say, this higher than normal rate at the Federal Reserve in the U.S. So the central bank is keeping the rate a little bit higher than normal, and that's causing that little bit of inversion you're seeing in the U.S. curve. And in Canada, it's a little bit more flat in, let's say, normalizing as the central bank here has been cutting rates for the last little while.
Right, and this comes back to President Trump jumping all over the Fed, Mr. Powell, in terms of wanting to see those short-term rates lowered, because pretty much across the G7 countries, correct me if I'm wrong, they're kind of the holdout with respect to higher rates compared to the other players.
Yeah, and that's a couple of factors on the U.S. side that have contributed to that. One is the stickier inflation, but also the resilience of their economy and the, let's say, the strength of their GDP over the last little while has probably outperformed what most people would have guessed at, say, a year and a half ago. And so that's kind of given the Fed this, let's say, cause for concern that inflation hasn't quite hit their target. So they would remain, let's say, elevated compared to other countries.
And one of the things that we're going to get the tariffs soon enough, but that's one of the things, as I understand, Mr. Powell kind of said that it's like, well, we have to see, what will be the impact of one of the impacts of tariffs with respect to possibly causing some inflation. So interesting to see.
Precisely.
So let's look at the spreads. So this is basically tracking the difference in, again, interest rates between the Canadian corporate bonds, debt, versus government bonds. So maybe talk us through this, what we're seeing.
Yeah, and this is a great way to kind of gauge, there's all kinds of news and information that flows into the market on a daily basis. And corporate credit spreads are one place you can look at to determine overall how much risk the bond market thinks there is in lending your money to companies. So it's a pretty good proxy because it kind of has to distill a lot of complicated information into one simple number. And so when you look at the spreads, now obviously when you lend your money to a company instead of a government, in most cases, that's going to require you to want a premium over the government, which we would call, let's say, a risk-free rate. So this graph does a great job of showing you how that risk premium changes that the market demands when they lend money to companies. And so what you can see generally from this graph over the last quite a long period of time here is that spreads have come down materially. They've tightened materially. And they're actually at quite low levels, maybe the lowest they've been in quite some time, and they seem to continue to get tighter. You can see that little spike right at the very, let's say, more recent period that during Liberation Day, that week of April the 2nd, there was kind of, let's say, a elevated risk premium coming into the bond market, but that has quickly unwound. And you can see spreads getting narrower and narrower as we move through time here.
And folks, the vertical axis, those numbers are basis points. What's the basis? So 100 basis points is 1%, what the spread is. So to your point, it's, again, from a market perspective, people are feeling that corporate debt is not risky at all, and is at, the spread is at, as you say, in one of the historical lows.
That's right. Yeah, you could argue the bond market is kind of looking through the tariff threats and the GDP risks that people have been talking about. By remaining tight like this, it suggests they're looking through all that.
Well, and you said the T word. I've said it as well. So let's talk. We're not talking taxes. That's another T word, but this is tariffs, and again, President Trump and what he's doing. And I think, I know when we had a call about this earlier in the week, he said, it's not too often we put up a graphic that goes back to the 1700s. So talk us through what we're seeing here.
Yeah, you're in trouble when you're pulling out something from the 1790s to make historical references, aren't you? Um, yeah, so essentially this data is, there's lots of estimates at what the current effective weighted average tariff rate is in the US from all the announcements that have come out, and it does change seemingly day by day. But this estimate comes from a reasonable, reputable source here. So this data comes from the Budget Lab in Yale. And it's their estimate of what the effective tariff rate is, and you're hovering around that sort of 17 to 20%. And one thing I can say, and that's so obviously you can see over a long period of time, this is unusual to have the tariff rates move this materially up. And you're going back into the 1930s and 40s to compare the last time we were at these levels of tariffs. One thing I might add, we've looked at this quite carefully, and it obviously changes dramatically, so I wouldn't want to mark this down in stone. But it looks like so far in the early days of the tariffs, it looks like roughly about 20% of the cost of the tariffs are being eaten by the foreign exporters. So those are countries outside of the US that are sending their goods to the US. So it looks like the foreign exporters have eaten somewhere around 20% of the cost. So the other 80% is going to either be eaten by consumers or the US importing companies. And so that's been playing out. It started off obviously at zero. They weren't able to pass through their cost to consumers in the first month. But as we've proceeded through, let's say July and August, you're hovering probably around 30 to 50% of the costs are starting to flow through to consumers. So it does take a bit of time for these effects to happen. And nobody really knows how those three, let's say, sources of pain are going to share the pain. And that remains to be seen, but we'll be watching that carefully as we move through time.
Well, and that's a really good point. This element of time. We think of these systems, and we think, when Liberation Day happened, and we think, oh my God, this is going to obviously kick off inflation. We think, call it the speed of response of the system would be quick, but in fact, what you're pointing out is a really good point. That, well, first of all, folks who follow this, they may have heard of TACO, the Trump always chickens out the trade. We'll talk about what we're seeing in terms of equities and the like. But companies, they're running excellent businesses, especially our core picks, and so they're trying to gauge this as well. How much do they eat versus passing along price increases through possibly, back to the taco aspect. Will Trump chicken out on these things or not? So they're eating some of this, but if that doesn't happen, if for some reason the trade policy sticks and the negotiations don't go very well, clearly, and I would guess, correct me if I'm wrong, this is kind of what the Fed is staring at, going, well, it's still early days here. We, great, importers, exporters are eating this. It's not maybe making it through to prices yet, but depending on what shakes out, that could in fact kick off a new round of inflation.
Yeah, that's exactly right. And you could probably pretty easily model, let's say 70 to 120 basis points of increase in prices over the next, say, year. That could be the cause of the tariffs. But like you say, it's going to take some time for that to play out. But it's easy to imagine a scenario where inflation stays stickier if companies are successful at passing along these costs.
So why don't we turn over to equities and look at the profits and what we're seeing. This is specifically on the S&P 500, bottom-up earnings per share.
Yes, and yeah, we would say these fundamentals are like one of the critical components of the health of a market. Earnings underpin price raises, and that's one of the things that makes stocks go up, is the fact that earnings go up over time. So it's always very important to stay focused on these fundamentals. So I'll talk maybe here just a few minutes about the S&P 500 as an aggregate of the entire U.S. market. Now, of course, we select our stocks independent of the S&P 500, but of course, many of them are members of the S&P 500. So it's not a bad proxy of the corporate profit picture in the U.S. So far, it's still actually only 2/3 of the companies have reported. So we still have about a third left to go. So we're kind of knee deep in it as of today. And so what I can say, it's been a reasonably strong and stronger than expected quarter so far, with the 2/3 reporting. So we have about 82% of the companies have beaten their estimates, which is higher than the historical averages. And they've beaten those estimates by about 8%, which would be a little bit higher than, let's say, the 10-year average. And one of the largest percentage beats since 2021. So it's been, let's say, better than expected. And one of the other things we've noticed this earnings season is that revisions, normally analysts, when they see the results, they start to ratchet down their revisions. They revise down their forward-looking guidance for the rest of the year or even the next quarter. This would be the third time since 2021 where that's actually the opposite. They've increased. Revisions have actually gone a little bit higher. So perhaps coming into the quarter, the analyst community may have been a little more pessimistic than was warranted by the success of these numbers. But as you know, things can change very quickly out in the marketplace. And maybe one last point that's not obviously clear from this data, but the growth rate so far for this quarter is hovering around double digits, like 10.3% roughly. And that surely will change by the end of the week, but you're around 10%. So that'd be the third quarter of double-digit growth, 8 consecutive quarters of growth. So it's been a reasonably strong underpinning of corporate profits under the hood there.
This is a great graphic in terms of looking at what the industry talks about, calls the Magnificent Seven, and looking at the earnings growth compared to the basically the remainder of the S&P 500. Talk us through what we're seeing here.
Yeah, and this is a theme that's been with us for a while. The corporate profit growth from the Mag 7 is the blue bars that you're looking at. So that growth rate, you can see just by the size of the bar. Boy, they were magnificent for more than one reason. But that's led to some of the concentration issues that you're seeing in the S&P 500, like the fact that the index is actually dominated by these 7 companies. But it's been partly due to some of these consequences of great fundamental performance under the hood. And so what you'll notice in the Mag 7 there is the growth rate has been much, much better than the remaining 493 in the rear view mirror. As we look out the windshield to the next forward-looking bunch of quarters, that gap between the growth rate of the Mag 7 and the rest of the 493 starts to narrow materially. And by Q1, roughly Q1, hopefully, by next year, that gap will be pretty much almost equal. So what we think that could cause is a little bit more broadening of stock price movement from the rest of the 493 instead of just this handful of companies that are dominating the indexes right now.
Interesting to see that equalizing happening. So in terms of then valuations, talk about here what we're seeing from a historical perspective.
Yeah, we'll start in the U.S. here. It gets a lot of attention, and obviously it's a huge part of the global economy. And this would be a graph of the valuation levels over the long period of time. And you can see there's sort of a pattern. It doesn't just sort of sit still. But you can argue that they're reasonably elevated in the U.S. And you can see even during Liberation Day, it's just a small little spike on that valuation chart that moves down a little bit, and it's very quickly recovered to its prior periods. So it is trading a little bit higher levels in the U.S., which we'll talk about some more in a few minutes.
And again, here in the middle is the 30-year average. So this is, again, averaging, obviously, over the last 30 years, and then basically one deviation up and down from that. So yeah, pretty elevated. That being said, I always love this graphic that you and the team pulled together. Folks know we have a sector-based approach to how we do investing. And so while the overall S&P may seem overvalued, the fact is when you look at it from a sector perspective, there's still opportunities for investment. Maybe talk us through this.
Yeah, we always say there's more than meets the eye on one PE multiple for the market. There's a lot more going on under the hood. We sometimes use, this is something we look at almost every day, or something very similar to this. It's not a terrible idea to think of it like a grocery store analogy, that the market has made up a whole bunch of aisles. There's 11 sectors underneath the hood in the US, and each aisle has very different things happening to it. So it's hard to just simplify and say the market is expensive. We tend to look at it, like you say, by sector. So this way of looking at things helps you find out which aisles might have all the sales. So that's one way to kind of simplify what we're looking at. And maybe I'll just walk you through it because it is a bit of a complicated looking graph, but it's actually quite simple when we explain it. That red line that you're looking at in the middle is basically the market's multiple, the S&P 500. So
the overall market.
Exactly. Call it 22 times that would reconcile with the graph that we saw just a couple slides ago. Anything to the bottom left and anything to the left of that red line would be cheaper than the market. So that's not a terrible piece of information to have if you're looking for cheaper stocks. Anything below that green line, so now you're talking about that bottom left-hand quadrant, is not only cheaper than the market, but it's cheaper than where that sector normally trades against the market. So now you're talking about a relatively cheap sector. So obviously anything in that bottom left is not only cheap against the market, it's cheaper than where it trades normally. And maybe I'll because that's a lot of complicated things to talk about. But healthcare, if you look at the healthcare sector as just as an example, is trading around, say, 16 and a half times compared to 22 times. So clearly, that's cheaper than the market. But the healthcare sector normally trades over the last 30 years roughly in line or up to a 1 multiple premium over the market, suggesting in a normal 30-year environment, it would be trading around 22 or 23. So trading at 16 and a half times, putting it down in that bottom left quadrant tells you that not only is it cheap against the market, but it's cheaper than when it normally trades against the S&P. That doesn't mean that it's an obvious opportunity. That just means that down that aisle, there might be some very interesting companies to go looking at.
Excellent. Love that graphic. So that's a view with sectors within the U.S., but let's talk about markets, from a geographic perspective across, again, comparing the U.S., say, to Canada and Europe, Asia, Far East.
Yeah, and this is one of the areas that also the U.S. gets a great deal of attention. But there's other markets, of course, where there's great companies, and many of those companies are global in nature. So it really doesn't matter that they're located in certain locations or geographies or trade on certain exchanges. But what you can see here is the comparison of the U.S. in the green line, the multiple, which we've already talked about. But it shows you what the valuations look like in the Canadian market and in the European, Australasian, and Far East markets, the EFI markets. And so you can see they're a lot less demanding. They're a little bit more cheaper, especially relative to the US. So that just tells you that diversifying by these other countries is also a wise thing to go looking for country or opportunities in these other countries. I think we have roughly, the last time I looked, we had about a quarter. So roughly about 25% of the names, the stocks that trade in the US are trading below 15 times earnings. And that number in Canada, in Europe and Japan is between 33 and 50% of the stocks are trading below 15 times. So it's a little easier to find some bargains out there in those areas.
Excellent. So this is good, a good graphic in terms of, when Liberation Day was happening through the Trump administration getting fired up, we went through a period of some volatility. So talk about what we're looking at here.
Yeah, it's funny that in such a short period of time here in 2025, we've basically had 3 very different market environments, all in 1 year so far. And who knows what the next handful of months has in store for us. But what we're showing you here is that, really depending on when an investor opened their statement, they may have experienced a very different feeling. And so in the very first part, actually, but maybe I'll just walk you through this slide because we got all the data there. If you look at the year-to-date experience, like from January 1st right through here till August the 6th, we're showing 2 particular sectors. We're just showing you the utility sector and the technology sector. They look like they're neck and neck. The utility sector actually is outperforming a little bit the technology sector, which may come as a surprise for many people that are, obviously caught up in the excitement around technology stocks. But the utility sector is actually outperforming the tech sector so far this year. Now, that doesn't tell you the whole story. So if we look at the period from February 19th to April the 8th, which was the week of Liberation Day, you can see that the tech sector had a drawdown of 29%. So that probably, if you opened your statements that quarter and you had some technology exposure, you probably weren't super thrilled about that. But if you compare that to how the utilities behaved in that very same period, minus 9.6. So that's one of the reasons why you want to be diversified around the sectors, because they do behave differently in different market environments. And one thing I can say for sure after doing this for almost 30 years is that the market environments are always changing. They don't stay constant. So it's very important to be diversified around these sectors. And then if you look at the experience in the more recent period, from April 8th to today, it's pretty clear that you can get pretty excited about tech again, because you've had almost a 50, more than a 50% increase off that bottom. And utilities, you might think, oh, well, that's not very good, only 19%. And really, that's just not true, because you've got to go back to the year to date and say, actually, utilities, in spite of the fact they didn't go down as much, they didn't go up as much, they've hung in there pretty well and delivered a pretty good performance for the year.
What's interesting about this graphic is this is over a period of what, January to August, 6, 7, pushing 8 months. And 7 months. And the fundamentals, I mean, we can sit there and talk about macroeconomics, but the reality is not a heck of a lot changed from fundamentals. This is, within reason. This is mainly being driven by the markets themselves and behaviors of players in the market reacting to, instant reactions to various announcements and the like.
That's right.
And this, I guess it just comes back to how we invest is very much focused on the fundamentals, that we're not going to get, sucked into the hype back to, when Liberation Day happened. We had, several podcasts talking about the fact we're not panicking, we're holding quality holdings, and we can't predict over the short term how the markets are going to react, and this is another great example of that. But what we can do is invest in quality companies that we believe will withstand the test of time.
That's right.
Okay, this is another way of slicing and dicing the basically, these are components of the S&P 500, correct? And you kind of sliced them 3 ways. So why don't we and look at the performance of those? Why don't you talk about these three curves?
Sure. Yeah, we figured, to go back to basics, when you think about the kind of companies that we try to identify and to own for a long period of time, they're higher quality businesses. That means they generally have pretty good representations of profitability, whether that's return on equity, return on invested capital, return on tangible capital, those kinds of things. Typical business person's ideas of what a profitable and high quality company looks like. And one of the symptoms of a company that can do that over a long period of time is that they'll pay a dividend, or they'll buy back their shares and they'll grow their dividend over time. And this is something we sort of identify as like one of our core tenets, that we love to see companies that have generated so much value that they can return some of that value to their shareholders. And so this graph basically takes the S&P 500 and says, well, how would the strategy have worked if you just focused on how companies used their cash flow? So the companies that use their cash flow to pay dividends and do share buybacks is that top blue line relative to the S&P 500. So you can see that strategy has done remarkably well. And we would argue that's kind of a symptom of the higher quality nature of the business underneath the hood. And then if you compare that to a company that uses their cash flow to just simply invest in capital expenditures or R&D, it's also done, okay there, but it's not done nearly as well as companies that share the wealth with their shareholders, and companies that have specialized in mergers and acquisitions using cash, haven't done nearly as well as the companies that have been able to share some of the wealth with their shareholders.
Again, another affirmation in terms of the approach, like you said, focusing on companies that pay dividends, buybacks, focus on their shareholders in terms of rewarding them for that level of ownership. It was interesting when we first went through this that some of the tech companies, you reminded me that many of the tech companies in the Mag 7 actually, they may not necessarily pay a dividend, but they do a lot of share buybacks, correct?
That's right. Yeah, that's one of the choices that management has, or at least the board has, to return capital. That is one of the ways you can return capital. They don't have to necessarily lock into a dividend every year. So we kind of look at both of those components independently, and buybacks is an important part of shareholder return.
This is the last graphic that we wanted to step through, and I love this because it's a good proxy for in a single slide, a proxy for, especially on the equity selection side of what you and the team look for. And so why don't you step us through this one?
Yeah, we sort of used a back of the hockey card approach here of the holdings that are basically on our core pick list, of the kind of securities that we like to populate portfolios with. Something that's not on the slide there, but I might just mention the average market cap. So the size of the companies that are on that list is 266 billion. So these are not sort of startups fly by night. These have been through world wars, recessions, all kinds of trouble, and have shown resilience over the years. But of course, that's going to be skewed by some of the large cap companies at the very top. So the median, so the middle market cap is around 73 billion. So once again, very large companies. The average ROE of those companies, 24% compared to the average of the Canadian and US markets around 16.8. So let's say higher quality than average. And you can see in the dividend yield, the consequence or the symptom of that quality is a higher than average dividend yield. And when you go to beta, let's just say a reasonable proxy for sensitivity or risk against a market, it's less risky than the market. And of course, we've been able to collect securities that are trading cheaper than the overall market averages as well.
Again, a great summary in terms of what you and the team look to achieve with respect to how we select equities for our core picks, as well as what goes into the pools. And I find what interesting as well is, first of all, back to the ROE, but the beta as well. By focusing on the fundamentals, beta again is back to that volatility, which I think many clients experience when we were talking there, what happened in February and March, that the volatility, most of our clients experienced less volatility compared to the overall market. Again, a testament to the approach. So Brian, any closing thoughts and comments as you look back on the quarter, and even if you look to the next quarter? Obviously, we talked a lot, focused on the U.S., but we have to be, in terms of, obviously they do have a huge impact on the global stage. But any more closing thoughts you'd want to share?
Yeah, it's been a tricky year, and I have a feeling we might be in for a few years of this kind of tricky environment that we're in, which can make a lot of clients feel, or at least investors feel, uncomfortable with the environment behind them. But I can say that the environment is never actually very easy. This one might be particularly hard, but what's very, very important is you stay focused on your fundamental approach and very disciplined about how you execute your approach. And I think that's something that when you pay professionals like us to do this, that's exactly what you'd expect. And that's exactly what we're focused on, and we'll remain focused no matter what environment comes to us next.
Great closing words. Brian, thank you so much for this.
Thanks for having me.
Folks, as always, if you have any questions, don't hesitate to reach out to your CPA firm financial advisor, talk to your TriCert Investment Counsel portfolio manager, or don't hesitate to reach out to myself. Take care.